Good morning. I've got Ryan here who's taping this lecture, so be forewarned that this is the first time I've done this. There may be some, hopefully not technical problems, or the lecture may not be all captured in the DVD. And the graphs may not come out clearly, so also I'll be writing on the board and they may be difficult. Ryan's going to try to help me as much as possible. Just remember that we're lecturing on Chapter 18 and the digital file has been uploaded to the MyMC website. Also, I'll be referring to the circular flow diagram in Chapter 3, and if we have time, we'll talk about the labor leisure choice model on Chapter 21, starting on page 454. You can refer to that. That's on the website also. But the primary focus is on the economics of the factor markets, which is Chapter 18, which brings us to the neoclassical theory of factor markets and the application of the laws of demand to the markets for factors of production or resource markets. And we are basically want to see or analyze whether the economic laws of supply and demand apply to factor inputs and how these prices of the factors, for example, wages or interest rates or rents, and the quantities supplied and demanded are determined. Remember from weeks ago when we talked about scarcity that all resources are scarce, factor inputs are scarce, and we're going to examine how the forces of supply and demand apply to these factors and how markets allocate resources. In this case, scarcity applies to factor resources also, and the idea that we're trying to underscore, one of them, is the economic laws as it applies to these resources and the efficient allocation of resources to avoid waste. Now when we talk about factor resources, we mean the three basic factors of production: labor, land, and capital, for our purposes. And these are factor markets or resource markets. And a market, in this case, is the market that provides one of the resources, land, labor, and capital, that supplies and the sources of supply and demand. We'll talk about these three markets. In the labor market, the wage rate, that labor market determines the wage rate and the level of employment. The wage rate being the price of labor or labor services. If we were analyzing the capital markets, we would talk about the interest rate as the price of capital. And the supply and demand for capital would determine the equilibrium amount of capital traded in the marketplace. The same thing for land. Land, we determine the land markets, the supply and demand for land determines the rent. Rent being the rental price of land. The equivalent for wages actually is the wage rate, is the price at which labor is rented. We will be focusing primarily on the labor market rather than the land market and the capital market. Maybe we'll say something about those markets at the end, but primarily our focus is on the labor markets. Now we may notice that, so we'll be talking primarily of the supply and demand for labor as the basic illustration of the economics of factor markets. Labor will be our example. The reason labor is primarily the emphasis in introductory economics is that labor is probably the most important input into the business production of goods and services. Labor costs account for, on average, 70% of the total cost of a typical business are labor costs, the rest being capital, materials, and land, and other costs. Labor markets determine our wage rates, which in turn determine our level of income, which determines our standard of living. Because of that, and the importance, for example, our income is to our standard of living, the issue of poverty is analyzed through analyzing labor markets. And you analyze labor markets by analyzing the supply and demand for labor. So our ability also to find job and work not only determines the economics of our lifestyle, the standard of living, but also there are a lot of psychological, the social impact. So the labor markets are important. When we have a job, psychologically people feel better, and they don't when they don't have a job. So a lot of it, job market and what goes on in the labor market, to some extent, it's just not economics, but it's psychology, it's sociology. It determines our self-esteem and our psychology. At the policy level, understanding the economics of the labor market is used to analyze important public policy issues. Minimum wage laws, the effect of labor unions, the effect of immigration, the effect of taxes on income and payrolls are analyzed through the supply, assuming a model of the labor market, that is the supply and demand for labor. Labor markets are used, the analysis of labor markets are used to analyze the issue of discrimination or racial preferences, such as affirmative action, and analyze the distribution of income. And as I mentioned earlier, poverty and wealth. All of that is analyzed by looking at labor markets. So one of the things, to start the analysis, and what we're doing when we're analyzing labor markets, is we're going to examine the forces of supply and demand. And just like we did earlier in the course, we want to derive the supply and demand curves, beginning with the demand curve. So we're going to start by looking, what is the demand for labor, and how do we derive the demand for labor? And then after this part, we look at the same thing at deriving the supply curve, or similarly, the similar approach in deriving the supply curve of labor. The first things, though, the preliminaries, to get those out of the way, is we have to realize that when we talk about factor markets, the roles of businesses or firms and households are reversed from when we were talking about labor markets. And just one second, can you pause this, Ryan?